Good afternoon and thanks for tuning in. You're watching Tracking Trends with me, Nikunj, the show on which we would ideate, debate, discuss and deliberate what is the best way to make money. You know, I always believe that there is a bull market on somewhere. Our job at DT Now is to simply help you identify that bull market. And the bull market in this year has just delighted everybody as long as you participated in that. So keep sending your queries. We'll keep on identifying the trends for you. Thanks for tuning in. But the big headline this Monday morning after a weekend is that the uptrend in the market continues in terms of stock-specific action. You may call the intraday graph choppy, but for me it is the holding capacity of the Nifty. Banks and real estate stocks, a bit of a mid-air turbulence, that's about it. But metals, media and pharma stocks are charging ahead. So what are we debating? What are we deliberating? And what are we going to be discussing at length? Number one, what we would be discussing is that will the Santa rally continue? We've been talking about the word Santa rally. Remember, happy Diwali to Santa. Everything in just 45 days. That's Indian markets for you. What is steering the FII flows into India? Is it just FOMO? Or this is real alignment of global risk back into emerging markets like India? And then, if FIs are back with the bank, what essentially one should be doing in terms of where the market is? So let me set the context here. In terms of setting up the tone. From July to now, what has happened to the market post FI were absent? Now that's data will just come up on your screen. So we are looking at from July to now. Markets are up 8%. Small cap index is up 26%. But March to July, if you look at the FI buying trend, then the markets are up 13%, mid-cap index is up 23%, and the small cap index is up 26%. But for me, what really matters is just one data, and I'll just walk up to Kunal and just talk about the data as well. We have seen what could be called as a monster buying by foreign institutional investors. 9,000 crore on Friday, 20,000 crore in last 6 days. This is the biggest net figure in last 5 months and the highest inflow in December in last 3 years. Now that is what we are going to be focusing on. What is going on? 9,000 crore. We socha hi nahi tha. 9,000 crore on a single day.
Correct.
This is not once upon a time.
Correct.
This happened on Friday.
Correct.
And 20,000 crore. And I think Kunal, we were discussing this point that ab nahi to kab.
Correct.
Kahan jayenge FIIs.
Correct.
But my only problem, Kunal, with that view is that everybody now knows the trick. And suddenly markets have become what could be called as one trick pony. Everybody is of the view that FIs will buy, they will buy more, and this number will go up to 40-50,000 crore in the run-up to the election.
Correct.
Let's look at the YTD performance, and what gives me conviction that we are not done with the buy figure is that there are two data points, one red and one green, and that data just tells you the real story. The YTD data for which is from the year almost like 2023, foreign institutional investors.
The negative 18,000.
18,000 crore. They were net sellers to the tune of 18,000 crore.
Correct.
And during that same time, domestic institutional investors have bought 1.7 lakh crore. So to put things in context, this number is looking strong because of SIPs.
Correct.
This number is looking strong because of the money moving into small cap stocks. And this does not account for PMS and HNI interest.
Yes.
Imagine if this number changes. It just becomes a positive.
This becomes extremely positive for the markets. And that's what we've been discussing over the last many days, that this number has to turn green. In best of the bull markets, whether it's 2005 to 7 phase, 2014, 2018 to 19 period for the bull markets, this was the major number which turned into green. It stayed green for months as well as quarters on a trot.
Now, I'm just going to give context here. Now just think about it for next 6 months. What is the risk to the market? Well, you don't know the risk of unknown. But if you take that unknown risk aside, inflation is cooling down. Political risk markets by and large have arrived at a consensus after the election outcome of states. And then in terms of valuations, that's not frothy at all. So what is the risk? See, you should never forget risk, right? What is the risk according to you?
See, as of now, there is no major risk which is attached, because globally things are turning around. Even we're not saying that globally things are at a euphoric or at a bubble kind of a point. Even for our markets, yes, there is one point where the mid caps and small caps have gone through a froth over here. They've gone through a time-wise consolidation, but still not one of the best time-wise consolidations which we actually expect or anticipate. That's the only region of froth which I'm actually worried about the market.
Will your pen work right now?
Yep.
Okay. Let me just use this, okay?
Sure.
Now, just remember this. This is the 5-year average. So 5-year average includes the COVID dip. And in last 5 years, this is the average at which Nifty has traded. And even though we are at an all-time high, now how this is derived, this is essentially EPS, market price, divided by EPS. This is that gives you the PE, right, Kunal?
Correct.
So P is the market price, which is the Nifty value derived by the EPS, and as earnings keep on going higher, this comes down. So what we are trying to say is that, guys, there is no froth. There is of course law of gravity which is at play. There is of course some irrational exuberance in some pockets, but the entire market per se right now is not expensive.
Correct. It's fairly valued.
What are we discussing?
So the point over here, Nikunj, is that the mid caps and mid caps over here, as you can see, this is at a bit of a stretch as compared to the benchmark indices. That's why we believe that large caps are still looking very attractive. In fact, when we look at the kind of stocks which have moved from the previous time when the FII turned into a bull market, you still have Infosys, TCS, which have been gross underperformers. HDFC Bank has rallied only 3% from the March 2023 lows. So I think in that aspect, there are still a lot of large cap names which are yet to participate and see a very strong rally for themselves.
Okay, now what's interesting here is that first let's look at the month to date, two charts please. Sensex or Nifty, whichever is easy for my producer, then HDFC Bank and Reliance. I just want to look at 3 stocks, and I think that for me is an indication of what and how you want to judge market. And I'm just going to turn back and just wait for those charts to load up. That's how markets have moved during the FII buying. Now that's the market for you intraday graph today. But in this month,
6%.
It's a 6%.
Correct.
Reliance, please, followed by HDFC Bank, and then Infosys.
4% for Reliance, 4.5%.
5% for Reliance.
Okay. Today I think
it's up. HDFC Bank, 6.5%. And then let's look at Infosys. It's just that when you see the data, you realize that how strikingly different it is.
Correct.
So for a stock which was supposed to underperform, is outperforming, and for a stock which was supposed to catch up, HDFC Bank and Reliance are underperforming. So FIs are coming back, but they are not buying traditional stocks. Let's look at what are they buying. In which stocks FI holding has gone up. That's a very mature way of looking at the market.
Yes.
Right? So it is not that there used to be a time when FIs will come and they will only buy HDFC Bank.
Correct.
They'll only buy Reliance. They'll only buy Infosys. But this time it's the other way around.
Yes.
In this uptrend, which is like a brutal, जोर का पैसा है, markets have not seen a lot of run up which has come from the sumo stocks. FI holdings, please, my producer will just fire some stocks.
In fact, it's Shriram Finance. So Shriram Finance is one of the stocks. AB Capital is one of the names which have done. Policy Bazaar, Paytm. And I was looking at the list of stocks, and I was, in fact, the average, so this is the list of stocks. Shriram Finance is one of them, Max Healthcare, Sona BLW. Many of these stocks have rallied up 40% from their March 2023 lows.
That's the point. So FIs are back, but they are buying differently. So if you frankly ask us, what are we trying to indicate? First point, FIs are back.
Correct.
But if that number of FI, which is red right now, 18,000 crore for the year, if that becomes green, then we are looking at maybe a strike by the sellers.
Yes.
FIs are back, but the money is not going back to traditional stocks. It is in fact going back into very different stocks in terms of where the setup is. And this time it is no longer Reliance and no longer HDFC.
No longer HDFC.
And that's a summary of today's influx.
Absolutely. Yes.
Wonderful. So I'm just going to wait for Jaideep now to join. And Kunal, thank you very much.
Thank you so much.
Thank you very much. Always a pleasure. I'm just go back and talk to Jaideep. Jaideep, how are you, my friend? Long time.
Hi Nikunj, long time. How are you?
I must share with our viewers that me and Jaideep go back for almost 22 years now. I was a cub reporter, and Jaideep was in the securities business 25 years ago, and he's still
managing. The full cycle. I did the bank and then came back to securities.
Yeah, so just that, Jaideep, I remember when we spoke, Sensex was at 3,000, now Sensex is at 70,000.
That's true.
So,
That's true.
we were discussing the importance of FIs. Everybody is now saying, kahan jayenge FIs? Ab nahi to kabhi nahi. Is there merit in assuming that in next 6 months, there would be FOMO, there would be desperation, and what we've seen in December, it is just the trailer of what flows will come in next year?
See, I personally believe that FI flows will have an uptick going forward. And my reasons, Nikunj, are again coming from the fact that a combination of how the US interest rates behave and how the dollar index behaves and how crude oil behaves. Of course, the fact that there has been a prediction or whatever, there's expectation that there would be a couple of interest rate drops in the US next year will fuel the fact that then FIs will have an issue of where should they be putting their money in a falling interest rate scenario, and they will look at equities. And if they look at equities today, then I think India, not even arguably, is in one of the sweetest spots in the world.
So what, to your mind, Jaideep, for 2024, since we are talking about market outlook 2024 from Kotak Securities, is the best asset allocation to have as a thumb rule?
I think that's going to depend, Nikunj, completely individual to individual. There could be individuals today who would want to do the classic allocations with the help of their advisors or their family offices or their bankers, or they could be the next generation of today, which believes far more in spending and putting money in SIPs than they've ever done. So it's really a combination of a set of these factors that from an Indian point of view, I think it's going to be a combination of SIPs. I think SIPs will continue going up. And then, of course, the classy HNIs will get their advice and take their calls on asset allocation, or the family offices will get their allocations along with their advisors.
Jaideep, do you think one should have two type of styles for next year? One from Jan to May, which is Jan to May pre-election cycle, and then post the election have a different strategy?
I think at a larger level, people might think of doing different allocations, not depending on 6 months, but I think depending on what valuations are the Nifty or the Sensex trading at. So I think it's going to be dependent on that rather than just a 6-month period. And how much money does actually come in, and if it's, and I was hearing your earlier conversation, that if it's a combination of both FII money as well as domestic mutual fund money, which is going to go into the equity markets, then obviously you could see a different range of the Nifty.
Jaideep, they say bull markets always climb the wall of worry, they come down on cherry consensus. I'm struggling to find any concerns, any wrinkles for the bulls right now. Isn't that a cherry consensus? Because cherry consensus never makes money. You always make money when you buy fear and sell greed.
No, you're right, Nikunj. I'm not even doubting what you're saying, but I think the non-availability of too many options from an investment point of view is also making the individuals keep their allocations in equities at their existing levels. And as I said, for the money which is coming in predominantly from SIPs, It's the sheer number of SIPs which are growing month on month on month is where the drive is coming from, and it's hardcore. Majority of it is hardcore retail money. It's the sheer number of people which are coming in more and more. So I think that part of the money, I don't think we'll see too much of reallocation into either removing it or putting it into other asset classes or anything of that kind. It's the HNI money or family office money which might take these strategic calls at various points of time. And of course, the FIs will take their calls basis, I think, clearly basis. The big factor is going to be US interest rates and US growth levels.
Your counterpart, Sanjeev Prasad, every time he comes out with a report, it hits our mailbox and then we react, then everyone reacts. The latest being that small and mid-cap stocks, auto stocks, a lot of stocks are trading well above their fair value. What would you tell Sanjeev Prasad every time he comes out with a report?
No, the fact is that the valuations are stretched on small and mid cap, and I think again, listen to your earlier conversation, that I think today the large caps, or the mega large caps, as I'd like to call them, are trading at far more realistic valuations than compared to the mid and small caps. So I think more money will go into those. And the fact that mid-caps... So
Jaideep, what is the trick to make money in 2024? I mean, 2023, all you had to do is close your eyes and throw a dart. As long as that dart was in your hand and you were ready to throw, it's been a rewarding year for equity investors, real estate investors, bond investors, Bitcoin, and even gold. So what is the trick to make money in 2024?
I think just stick to what you think your asset allocation should be. Because ultimately, it is, I agree with the fact that it's stocks which make money, it's sectors which make money, but ultimately, equity as an asset class is giving you the returns. Or it does not matter whether you buy X bank versus Y bank. Yes, I agree with the fact that some of the banks or some of the stocks have not done as well as the other. But ultimately, I think it will even out in the long run. So I think just stick to the allocations which you think works best for you. I think again, I repeat, at the next generation or this current generation level, I think they don't do too much of asset allocations, etc., etc. I think they'll just be continuing with their SIPs. The larger sets of individuals will do their allocations basis the valuations of the equity markets and the interest rates where they are.
Final question, and a bit of a hypothetical question. Imagine if you are allowed to invest only once and then go on a long holiday without your mobile phone, no access to emails, and you'll only check your portfolio after 3 years. After 3 years, no mobile phone, no email. 3 years, Jaideep goes on a long... Sorry?
Nifty.
अरे ये तो easy answer है. ये तो easy answer है. I don't expect this to come from Kotak Securities. You do all the hard work on this specific.
That is the best answer you can get from me. Just put your money in the Nifty and go on a holiday.
Nifty or Bank Nifty? Let's nail it down to चलो दो का option लेते हैं.
70% Nifty, 30% Bank Nifty.
Okay. Really appreciate your time. And by the way, when you say this generation of investors, what are you referring to? Your age or my age? That we're becoming old?
I think far smaller than that.
You know, I was sharing with the viewers that Jaideep and me have been old friends. My friend, we met in 2001, I think, for the first time. It's been 22 years now.
That's right. It's been north of 20 years that we've known each other.
So nice to have you back, and thank you very much.
Great, Nikunj. Bye. Thank you very much.
Let's take a break. When we come back, Sanjeev Bhasin and some questions where we'll tell you about some specific advice. Well, thanks for staying with us. You're watching Tracking Trends with me, Nikunj Dalmia. Now, queries. Thank you first. I just want to thank our viewers that we are getting a resounding response to the number of queries. We'll try and accommodate as many queries as we can. Now, the first query we've got is from Rajiv Gupta on Paytm. Now, Gupta Saab, why has Paytm fallen? And you bought 750 shares at 755. Should you add or book profits or average it? So Gupta Saab, the reason why Paytm has fallen is because Reserve Bank of India has come up with changes in the unsecured loan book. And the loan what they actually generate from NBFCs, that in a sense could come under pressure, the spreads could come under pressure. Now the minute we think of Paytm, we always think Paytm Karo, UPI is what their main identity is. But apart from that, Paytm does not really make too much money in UPI. It does make money in really initiating loans. And that's where the spreads come under pressure after Reserve Bank of India new changes in terms of risk-weighted average. So Sanjeev, while Paytm is a very household name, you know, everybody resonates with Paytm. But there are two things which could have an impact on Paytm, Mr. Bhasin. One, Jio's entry. B, Reserve Bank of India's new diktat in terms of what the NBFCs have to do in terms of risk management, weightages have to be changed. Could this have a permanent impact on Paytm's future profitability? Could the path to profitability, Bhasin Saab, will that be challenged?
So Nikunj, as I've always said, you know, the RBI diktat was more in the face of before this whole, Fed pivot change. And they were being cautious because they felt that unsecured loan had grown very rapidly. Rightly so or wrongly, the company already has clarified that co-lending had been a key player in this, and they were part of that in their loan book for vendors and kirana stores below the status of 50,000. They have said that they will reduce that book and increase it to 5 lakh. And I think that the RBI diktat may be short-lived. If we are going to see inflation and bond yields moderate, then, this tightening of RBI or being cautious may not be that far-fetched. B, Paytm is a no-brainer. They are saying they are doing 5 times more, India is doing 5 times more digital transactions than China. Now, in all this gambit, the technology reach which they have and the brand which they have, I think it's a steal at this 600. So the only caveat is that it is overowned by FIIs and there will be a couple of the soft banks of the world who will have to unload. But I would use this opportunity to buy, if he has it, to stay put and wait for more clarity. Give it a quarter or so and you should again see it rebound back to about 850, 900.
So Mr. Gupta, I think the advice from Mr. Bhasin is that don't book your profits, part one. Wait for maybe a further decline if you want to add more. But it's a stock from these levels, I think is pricing in a lot of bad news. I always say in the market, it's not the news what is important. What is important is how much of good news or bad news markets are pricing in. Our next question is on Wipro. And we got Mr. Chandrasekhar. He's bought 79 shares of Wipro at 446. Let's look at Wipro's stock performance in last 3 years. Wipro, HCL Tech, TCS, Infosys. Let's compare all the 4 stocks in last 4 years just to give you a sense. And why am I saying last 3 years? Well, you've had a COVID sugar rush and then a adjustment post the problems which have happened in Europe and US. So before I go to Sanjeev, I just want to, look at those stocks right now in terms of the change in a stock price of HCL Tech, Wipro, Infosys, TCS. These stocks, just bear with me, I think they're just taking some time before they come up. There you go. Wipro in last 3 years has given you a 77% return. Flip it around, which is the next one. HCL Tech has given you 150% return. Then let's superimpose it with Infosys and then we'll talk about TCS. TCS 74% return and then Infosys is the last one. Now Bhasin Saab, as a stock, Wipro frankly has been an underperformer. In 1 minute you have to give advice to Mr. Chandrasekhar. Should he stay with Wipro or it is time to move to some other IT stock?
No, I would say stay with Wipro. See, Wipro had a couple of issues on their new acquisitions. The cost of new acquisitions ate into the margins. But their BFSI space and, the new compounding of where they use their cash is doing extremely well. I think now Wipro can be an outperformer. In fact, I would say that he should add it closer to 400 more. and I think Wipro is headed to pass 500. So what it has missed out in the last 1.5 years, I think now it is poised to be an outperformer on the IT basket in the Nifty.
Chandrasekhar ji, the stocks become cheap, and anything which becomes cheap, I guess, becomes in the value zone, and my sense is Wipro is just about reaching there. But since thank you very much, and thank you for joining us. That's it on this edition of Tracking Trends with me, Nikunj Dalmia. After this is break, last 1 hour of trade. That's will capture life.